He pitched us in that $17 billion round, and I did a Zoom with him. And after the Zoom, I'm like, this doesn't make much sense, but I'll have my team do some work. We did some work and we sent him a 2-page deck. And we said, here are our recommendations for taking the next step. One was the formation of a board. The second was the creation of dual class stock. The third was some reps and warranties around affiliated transactions and related party transactions. And the person that worked there called us back and literally, I'm not kidding you, said, yourself.
In an interview with Coinbase CEO Brian Armstrong, the billionaire Canadian-American venture capitalist Chamath Palihapitiya shared his thoughts regarding the FTX collapse. Crypto Twitter has alleged that Sam Bankman-Fried was on the run and tried to flee to South America. Others believed he tried to flee to Dubai. Cointelegraph reported that Bahamian authorities have Bankman-Fried and 2 other executives under supervision. Reuters reported that they reached out to SBF to ask him via text if he left the Bahamas. He said no, after lying to his followers constantly on Twitter about anything relevant to FTX. It would be very hard to imagine him replying, "Yes, I'm on the run." More and more high-level people are sharing their experiences with SBF and looking back for any red flags and what they might have missed. Elon Musk confirms on Twitter a story about SBF investing $3 billion into Twitter. Elon said that SBF set off his BS detector. As a guest on the All In podcast, Brian Armstrong also suggested something was off when he compared Coinbase's revenues to that of FTX, but for whatever reason, SBF had substantially more cash for donations, corporate buyouts, etc., being heralded by CNBC as the White Knight of crypto. Chamath Palihapitiya also shared his own experience with Bankman-Fried, but instead of focusing on SBF, Chamath went deeper into the subject, and he believes there's a systemic issue at hand that needs to be dealt with immediately. But before we listen to Chamath, if you are new to the channel or not subscribed, make sure to subscribe so you don't miss any videos.
There was an article that appeared that said that the head of compliance at FTX was also the head of compliance at a poker site called Ultimate Bet, which in the 2010s did this exact thing, apparently. Some version of this where they went in and they looked at hole cards of poker players, and then a few employees inside the business would basically play against these folks, knowing what the hole cards were, ran this cheat, stole millions of dollars. Somehow that person found a way to be head of compliance at FTX.
Yeah.
10 years later, which is incredible. But back to this question. So now what happens now is you have the international business and the US business and Alameda Research all rolled up into this one frozen entity, right? With now regulators having to, so do you know what happens in a process like this? Like, is it that the DOJ and the SEC get priority, or is there some international monetary, like who unwinds all of this? How do people get their money back, if at all?
Yeah, so I'm not an expert at this, but my high level understanding is that the bankruptcy courts will essentially, and I believe they filed bankruptcy in the US, which is an interesting thing. I didn't know why they did that versus Bahamas. But anyway, the bankruptcy court will basically go through and try to find any assets of value. So, I mean, they still have some tokens and value. They have a venture portfolio. I think Sam owned 9% of Robinhood. There's various things that they may own. And then they'll kind of auction those off to various bidders on distressed assets and then try to distribute those funds to the customers. I don't know the exact process beyond that, though.
There was an interesting thing that Larry Summers did, I think, for Bloomberg, where he was asked whether this was Lehman or Enron. And he said, it seems more like an Enron than it is a Lehman. And Brian, I'm just curious how you think about it. Like, is this sort of a fraud perpetuated by a group of executives to essentially take advantage of a situation? Or do you think that this is more like a Lehman situation, which is a well-run business, I guess, that just, got caught in a liquidity trap?
I think my guess is it's a little more like Enron in the sense that, I mean, yes, they were over levered and that kind of thing, but the minute that they moved customer funds in some way, shape, or form to backstop the hedge fund, that was, in my mind, fraud. And, that's more like Enron.
Do you think now that we have to open the gates on regulation, like the whole point of crypto in some ways was, trust nobody. And, decentralization is the key. But here, what we see is a lot of people were tricked into trusting FTX and having their deposits there. And it was a centralized exchange, which caused all these problems. So it's like, it almost violates the principles of what the whole product market fit was supposed to be. So what should sort of the observer expect? And what do you expect as a business in terms of how governments now react to all of this?
Yeah. Well, I think it's really important to distinguish between the centralized players in crypto, which are custodians, exchanges, et cetera. Coinbase has a big business there. And the decentralized players, which are, self-custodial wallets, DeFi protocols, Web3, that whole world. So the centralized players should be regulated. And today they're regulated already like kind of traditional financial service businesses. But they don't have the regulation clear when it comes to the crypto aspects. So for instance, in the US, we actually don't still have clarity about what is a commodity, what's a security, which one should CFTC regulate versus SEC, that kind of thing. And that lack of regulatory clarity, and frankly, the climate of regulation by enforcement, the negative rhetoric from Chair Gensler in particular, has created this sort of chilling effect in the US that has pushed a lot of that centralized actors' activity offshore. In fact, 95% of the trading volume in crypto is now outside the United States, and it's come down a lot since the beginning of this year even. Now, the decentralized players, self-custodial wallets, DeFi, Web3, this is where crypto really has an opportunity to make a more fair and free and transparent system, because you can go look at any smart contract to see exactly what it's doing. Anybody can audit the code. If you have a self-custodial wallet, you can just trust yourself. You don't have to trust any other intermediary out there. And that's where you get true decentralization. And I think that's actually, now, those areas still have a couple of their own challenges. Sometimes people will lose their password or their phone and they'll lose their own money. So if you're trusting yourself, you still have to trust, that you're going to do that piece correctly. But there's a lot of good things we can do there around making social recovery mechanisms and MPC wallets and things like that.
But to me, it seems the whole issue, if you come back, like what is the first string that you pulled that unraveled the sweater, was the fact that these tokens were created out of thin air. They had no meaningful value. Somebody prescribed a value, and all of a sudden, everybody else in the economy all of a sudden said, yeah, I'll take that as collateral. Look, you cannot do that in the regular world. I can't call JP Morgan and say, I've invented this thing. It's called a share in XYZ, and I'd like you to margin loan, give me a loan against it. So Brian, explain, there's a ton of these tokens that have been engineered, right? And there's been a ton of these tokens that have been sold. So what should people do that own these things thinking that there was going to be some safety or value or, how do you think about all of these tokens that could be as basically as fragile and shitty and worthless as FTT?
Yeah, well, there is this concept of an exchange token, and there's a couple other firms out there that have them, and that's something we haven't done. And I think you're right. The actual utility of those things is a little questionable. And so if someone's going to sort of mark those up on a low supply and then a low float and then somehow leverage that's going to get yourself into trouble. But look, I don't want to throw out the entire concept of people creating tokens. I think there's actually a lot of good stuff there. And it comes down to this idea of if you're trying to raise money for your company and through a token, that's fine. That should be a security. And there should be a regulated way to do that in the US. Go register it with the SEC, let it trade on broker dealers. That's what we've been wanting to do for a long time. And the SEC is taking their time getting there. They don't, Gensler, to be honest, he doesn't seem that excited about the idea of this whole industry existing. And so anyway, but it should exist, and it should be happening in a regulated way. So if people want to issue a token that's raising money for a company, let's regulate it as a security. If they want to issue a token that's truly on a decentralized protocol, or it has some other purpose like voting in a DAO or rewards or something like that, then that's probably not a security. And let's be honest about that and allow those things to trade in a different environment, a different regulator under the CFTC.
We're probably running out of time with you because you said you had a hard stop. So let's ask the $1 million question. Tell us about SBF. who is this character?
So again, I'm speculating here. I mean, I've spent time with him. I've met him a bunch of times, and I have to say, I did not see this coming. Like he appeared to me to be a very bright, credible, competent person, perhaps a bit young, perhaps, a bit reckless at times, but not unethical and not committing fraud. I definitely did not see that. If I look back to see, were there any warning signs that I should have thought twice about it? One of the things I noticed was that in 2021, Coinbase had a good year. We did $7 billion in revenue, $4 billion of positive EBITDA. We became public as a company. At that time, FTX did about $1 billion in revenue. And I knew how much money we had for our venture budget and just like different investments we wanted to make. And I knew their revenue. And I had to scratch my head a bunch of times. And I was like, where is this guy getting all this liquidity? Because he was like buying 9% of Robinhood. He was putting like $1 billion into this. He was donating to all these politicians. And I was like, it did not make sense to me where he was getting all this cash. People just kept telling me, oh, his market maker Alameda is just printing cash. And I was like, okay, I guess, it seems like a conflict of interest to own an exchange and a market maker. That's why we haven't done it, but more power to him, I guess. And so I was surprised. I didn't speak up. I can't explain the psychology of it at this point, whether he's a pathological liar or if he's started off good and somehow under the pressure of this whole thing went bad. But the minute you can go watch the interviews, he's lying to people about why he's bailing out Voyager and BlockFi and these, and he knew at that time that most likely he knew at that time that they were not solvent. Alameda was not solvent, and so that's where he crossed a major line in my book.
I think the problem is bigger than FTX, and I'll say the uncomfortable part out loud, and nobody needs to necessarily comment if you don't want to. But there were an enormous number of venture firms that talked their way into just completely doing zero work here. That tweet that he had where he basically took the snapshot of the Sequoia transcript was one of the funniest things that I've ever seen. I mean, this was a $215 million decision, and Sequoia documented it and put it on their own website. And I think that's an example of something that was happening, which is people just looked the other way and didn't even want to do the layer of work. I just want to say the second uncomfortable thing out loud, which is there was a lot of venture firms in Silicon Valley in this period of both not doing any work or diligence who also took the extra step and actually created classes and would teach teams how to create these tokens. Okay, and those artifacts, those video links and artifacts are sometimes on their website. They're still on YouTube. They're inside of Twitter. And what these folks would do, and we talked about this, the game that they played was they would get a team, they would create a token, they would also buy equity at some crazy valuation. The equity was locked up, but the tokens were not. And then they would put them on an exchange and sell them to unsuspecting people, and they would be able to dump these tokens. And if you look inside of that trend, what you're going to see, and Brian just mentioned this, those were the sale of securities, except it was done in a completely unregulated way. So if the SEC is really, and the DOJ is really going to take this FTT token issue seriously and what happened to FTX, they're going to start to look at a bunch of other tokens and token sales, and you're going to end up looking at some very well-known venture firms inside of Silicon Valley. That token, guys, let's be honest, is not the only token that has been engineered by Silicon Valley venture firms. And it is also not the only token that's gone to zero that was engineered by Silicon Valley venture firms. Jason, there's videos today on some of the most well-known venture firm sites on how to do this. My biggest purchase ever was Bitcoin in 2011. I've bought a bunch of these tokens that have massively depreciated in value. I think lots of investors have. I kind of fell into it as well. Like I thought, wow, this is incredible. I get to buy these tokens. They do all of this cool stuff. They represent all this value. And my experience has been the opposite of that. I've lost a lot of money in these things. And so, I really hope that regulators, not just obviously, I hope that regulators do the best they can to get investors' money back in FTX. But I really also hope they figure out all these other tokens as well, because you can just rank them in terms of market cap, start at the top and work your way down. And you will see that these were unregulated securities, Jason, that were manufactured and sold by our brethren. You know, Citadel does this in the regulated market. That's what payment for order flow is. It's the ability to front run retail volume. And so, you know, in dark pools, that is legal by the law in the United States. And that's what allows Citadel and, you know, I think Jane Street and Susquehanna, you know, all these folks basically run these dark pool exchanges for regulated securities like options and bonds and stocks. And they get this order flow and they front run it by a millisecond, and they just take small VIG. I just think that there's these really strict walls and segregation, as you heard Brian talk about, when you have those businesses in these regulated markets. The problem here is that this is totally
Wild West,
unregulated, wild west. So who knows what's going on, really?
To watch the full interview, check out the link in the description. What do you think of Chamath's thoughts here? Do you agree that this is a deeper issue than SBF? Leave a comment. If you are new to the channel or not subscribed, make sure to subscribe so you don't miss any videos.